Welcome to the Dividend Talk podcast, episode 73 Spin offs and Earnings. Hey guys, welcome back to another episode of Dividend Talk. In today's episode, we'll finish off what has been a busy earnings period while also discussing some of the latest spin offs that's been in the news recently. All that and more. See you on the inside. Good evening, European DJI. How have you been?
Well, really good like usually. A bit busy at work. It continues to be really busy there. But oh my god, what a week, right? And what a killer at the end of the week here with the news of Johnson Johnson.
Yeah, there's been so much happening, and I think we've got a really jam-packed podcast here today. This episode is going to try and fit in lots, so bear with us. We're going to try and fit in spin-offs, earnings, questions, portfolio review, and we'll see. We might have time for a stock pick, but we'll see how we go. But Johnson and Johnson, I mean, I watched your video on Johnson Johnson. It must have been about a month ago, and boy, you must have a crystal ball. You must have something, or you must be talking to these CEOs, because I think you hit the nail right on the head again.
Well, I think they're just listening to Dividend Talk podcast. It's simple like that. I mean, we're kind of iconic now, right? After 1.5 year. Now, but for the listeners, I did a deep dive on Johnson Johnson like 3.5 weeks ago. The reason for it was really simple. I realized that after 4 or 5 years holding the company, I didn't know anymore what their main, story is at the moment. Of course, we all say like it's an iconic dividend payer because it grows their dividend like clockwork. But I was reading the other day the book of General Electric, which was also a company raising their dividends like clockwork until the whole I said card deck of cards fell apart. So I was a little bit thinking like, hey, Johnson Johnson, it sounds a little bit similar. Let's look into it. I mean, I didn't expect any fraud or something like that, of course, like General Electric. But my main takeaway really was after analyzing Johnson Johnson, and I was quite surprised about that, was that I should start treating it as a pure play biotech because their consumer business went nowhere over the last 10 years, literally. Medical devices actually also not really. And the main growth driver has been pharma and their main drugs and actually just three types of drugs and their products, which tells me that when everyone says it grows like clockwork, underlying in their business, there's a lot of risk. And from that point of view, you could even argue that Johnson Johnson poses more risk than most of the other dividend kings and dividend aristocrats because you're solely depending on the growth of their top three big products. That was a surprise to me. I didn't know that when I didn't realize it, let's say like that, because I always thought like, well, diversified medical devices and the consumer business, but actually they had no growth at all. Now you could argue if biotech starts growing less or declining, then the others will pull up. But the others have not been pulling it up in the last 10 years. So I rather see them, my thoughts here being spun off, at least the consumer business, so that we actually know better what we own. And I think a consumer business should be compared to how P&G and Unilever are doing,
Yeah.
and the likes. And they are trailing behind those companies, but by far.
Yeah, and it's funny you mentioned well diversified, because Johnson and Johnson kind of beat that drum, don't they? That they're a well diversified company, and that's what alleviates some risk in downturns. I mean, they're in pharma, consumer health, and now for those that don't know, they are now spinning off their consumer products division. So that's best known for like their baby shampoo or their talcum powder or band-aids. So they're now spinning that off. So they're getting rid of that. And do you think that will affect their? Obviously, it is going to affect their diversification, but what they were saying before is in now, it doesn't really hold true. They can't weather all storms because they're not as diversified as what they used to be.
Yes, true. And in my opinion, it became a company like Roche, actually. Roche has also pharma business and I think a dia business. And in this case, it will have a pharma business and a medical devices business. And it's really good because to have those two main, how I say, units in the company, because it allows them to address the whole patient journey when a patient is ill. Yeah,
Yeah.
but they first need medical devices to assess what the illness is, and then they need the cure via the drugs. So that's really good. We became a pure play biotech company, and the consumer goods business. Well, we all know what happened with talc powder with the spin off as well, right?
Yeah. Yeah.
So we shouldn't forget that one as well. So it's actually three entities now, right? So you have the consumer goods, but also the talc powder limited company, which they will declare bankrupt, right?
Lawsuit Limited, we'll call them.
Yeah, lawsuit limited. Yeah. So yeah, I mean, big news, I would say. And have you read anything about the dividend actually?
Yes, as far as I'm aware, they will be maintaining the dividend as it is. That's not going to be affected. They also said that it's going to be they plan to make it a tax-free transaction. Now, maybe you might know or somebody might know, but in my mind, that means they'll be just spinning off the shares, and we get the shares at new spin-off. Um, that's what my understanding of it, but
Yeah,
that's just me. I'm not entirely sure.
that's my understanding as well. And I don't either see Johnson Johnson as a company that pulls something off like General Electric did like 6, 7 years ago when they spun off their finance business, where shareholders saw nothing of it. I really hated that at the time.
Yeah,
But yeah, yeah. So what I understood from the dividend, by the way, is that they at least want to keep the dividend at the same level. But
yeah.
I understood across the two companies, right? So how I took it is that both the spin-off, the consumer good business, and the biotech company together would be at least still the same dividend from the get-go. But that was my understanding from from what I read. But maybe I'm wrong here.
If that's true, then they will they lose their status, the dividend aristocrats or dividend king
I don't
status?
know. It will be probably something more like other
Abby,
companies have done before. I really don't know, but it wouldn't change my thinking
no.
as such. But tell me, what are you going to do? Do you want to have such a business that is depending on Listerine, mouthwash, and talc powder and such?
Nah,
Are you
probably not.
interested in it?
I have
No.
no real interest in keeping that as a sole entity. We'll see. We'll see when they are distributed what they're worth, the price. They might be worth holding on to for a little while, but um, I'm not really too concerned. I'm more than happy to just have Johnson Johnson with pharma and medical devices. Maybe we might see them split that in two at some point. I'm not sure, but what what is your overall thoughts? Do you think it's a good thing? Are you happy as an investor, or do you think they shouldn't be doing this?
I think it's a good thing. I mean, when I analyzed the company 3.5 weeks ago, I didn't see the benefit of diversification because if your consumer business over the last decade has been effectively flat, then why having it?
Hmm.
Yeah, you can as well just sell it then at a premium and then reinvest it back in the business.
It's interesting, isn't it, that lots of companies now, and it's becoming more and more maybe apparent, but lots of companies are now starting to undiversify themselves. I mean,
Yeah,
Abbott, AT&T, Pfizer come to my mind. Um, they are now trying to go back to their core, and I feel like technology has a lot to do with that. I think it's a lot harder now to spread yourself thin, where there's new players that can come in that just solely focus on one area, and they can outgrow you so easily. So I think it's just really I don't know the right word, but it's just for me. I see companies are focusing more on their core. They're able to allocate the capital correctly, more probably more targeted investment opportunities, and maybe just to realign their corporate structures. But for me, it's really interesting to see all these companies going back to their core. But I look, I think it's the right move. As we can see, the consumer it's not been growing. I mean, 1.1% growth in 2020 on their annual report. I mean, it's basically flat. It basically hasn't grown. I think you showed in your video it didn't grow over the last was it 6 7 years maybe. So
yeah.
it's been a trend over that. So if that part of the company is dragging you down, I think it's only right to set it free and let it go. But um,
Yeah, and it says a lot also about all the synergy that people see at acquisitions, right? And we know that Johnson Johnson in general is a holding company already for decades, so it's a high quality company. It doesn't change the fact there, but for me, it was already a biotech company since I last analyzed it, and that's funny, right? This was the reason why I'm not surprised, and it confirms again, like how much important it is to know what you own. Because we were
yes,
talking a little bit before the show. How many times do you see Johnson and Johnson stock analysis popping around on social media or one of the blogs?
you don't see it, and they are touted as a reliable company, dividends paid like clockwork. And I mean, I think I've fallen into that trap myself. I actually don't know if I dug deep enough into them to warrant that. Now, it reflects my portfolio because they're not a huge percentage of my portfolio either. But I think you're right. You need to know what you own. And I think your video has been excellent on that. And it's done half the job for me. But I would have seen them more 50-50 before with consumer and pharma and not even realize that the farmers are outpacing. So it's very, very important to maybe once a year refresher or maybe once every couple of years just to make sure you're up to date.
Yeah, I think that's what it is, right? Because it does cost time, but once a year, reading the 21st pages of an annual report is usually enough. But
Yeah.
you know, if you own 30, 40 companies, that's like as big as the 800 page, what is it? The Book of the Snowball from Warren Buffett or by Warren Buffett, which is not easily finished.
Yeah, but Johnson actually have a nice one. I think they've condensed 8 pages, and then after that, it's all their
Yeah, true.
figures. They're 10K, so it's actually not too bad.
Yeah. Okay, so that's about Johnson and Johnson. I think we cleared up the air there a little bit. We got quite some, how I said, questions about that. Also, quite some interest in the community around this. This is based on what we know today. We still need to probably study a little bit further. I'm also very interested to hear more from the CEO about this. I'm sure we will hear more news in the upcoming days and weeks, and we'll keep you updated on the Dividend Talk podcast because we realize that it's probably a one of the positions that most of our listeners have in their portfolio.
Yeah, and actually, you mentioned the CEO, and I know he's on his way out, isn't he? I think he has a year left, Gorski.
Hmm. Yeah,
So,
yeah, yeah.
so I wonder if he's driving this or is the new guy driving this.
I
Uh,
have no clue. I have no clue. Yeah, I would need to look it up.
yeah, yeah, no,
Yeah.
it's interesting. Anyway, we're talking about spin-offs. There's been another one in the news. I'll have to admit I'm going to rely on you for this one because I haven't had the time really to go through it. But General Electric are spinning off into not one but three different companies.
Yeah, true. So, full disclosure, I own General Electric. It's one of the biggest pains I've ever gained in my portfolio. I kept them as a reminder, and I'm using them already for 3, 4 years as tax harvesting, based on the option gains that I make. What I What, but there is a second reason why I kept General Electric, and that's as a turnaround play. Because at a certain moment, I wanted to sell it when it was at the bottom of the chart. Let's say I did my analysis, and I felt like, well, actually, it's so negative that there's too much priced in here. But also, Larry Culp came in, who was, I believe, the CEO of Danaher before, and I really, really enjoyed seeing him what he was doing at Danaher, and he made straight away a good impression on me. And this spin-off has his footprint all over it because if you think about the history of General Electric, Jack Welch building it in this big conglomerate, because of synergy between all those businesses, but it was really driven just by their financial financing business. They were just cooking the books continuously. Jeff Immelt couldn't keep it up like Jack Welch. He was how you say it, doing a lot of window dressing, but in the end, the whole ivory tower and the whole house of cards fell apart. Then there came a third CEO. I forgot his name already. He was an insider, and then came Larry Culp, and he has been just doing an amazing job. He's been paying down lots of debt. He rewinded the initial GE Healthcare spin-off, and since then he has been every year really nicely, how is it, making the business much more healthier and setting it up for the future. He does get a lot paid. It's like really, really double-digit millions. So there's a lot of controversy there, but he's doing everything right. And now they have decided to spin off the business. So there will be three businesses after this. It will be GE Aviation. So it's about all their turbines and this what they're selling. They've got almost a monopoly there. I believe Rolls Royce is still a strong competitor. Then you have also GE Healthcare, and you have the GE Renewable Energy, GE Power, and GE Digital businesses to become an GE Energy company. The healthcare business will be spun off in 2023, and the energy business in early 2024. And the aviation business will move on with the name of General Electric. And what is interesting there is that GE, so the aviation business, will continue to have a approximately 20% stake in how you say it in the healthcare business, which is good because the healthcare is really like their how you say it their crown jewels in the
Yeah.
company. So I think it's again like the unmantling or the dismantling of an conglomerate that and in this case they are also talking about tax-free spin-offs. So I believe we should all get the shares. I'm quite excited about this. I will probably sell straight away GE Energy because they have also Alstom in there. This French misfit.
Yeah.
I don't believe in GE Energy at all. I think Siemens is a much better company to own from that point of view. But I will definitely consider to keep GE Aviation and GE Healthcare. And I believe also with that, we will probably see some dividends again, because I don't see a reason why both GE Aviation, but especially GE Healthcare, can't pay a dividend, actually.
Did they have they mentioned? They haven't mentioned that about a dividend, have they?
No, they've always kept one dividend per share per quarter. I think they want to be able to say after 200 years that they never stopped paying a dividend. But they slashed the dividends at the time from 20 cents to 1 cent or something like that, probably after the stock reversal. So not the stock split, but the stock reversal. It became 4 cents or something like that.
Okay.
Um, Larry Culp will be a non-executive chairman of the GE Healthcare company. So not the CEO, but he will, how is it? I believe that he will not be anything after this. So it looks like he is retiring because all the other businesses will get a new CEO. So it really sounds like he will be retiring and becomes a non-executive chairman.
Okay. Interesting.
Yeah. But he
Interesting.
did an amazing job. For me, Larry Culp is one of the best CEOs that I just know.
Yeah.
The mess that he had to clean up in General Electric and how he has been communicating around it, it deserves almost like a Nobel Prize.
They might write a book about it.
Yeah, it's just pity that it's General Electric. Yeah, you could wonder, couldn't he have served his time as a CEO not better on a company that is not that damaged and broken,
Yeah.
right?
Maybe he enjoys those challenges, and I mean, when a company is that broken, you can't really fall much further. So it can be a
Well,
win-win. Do you know,
that's
like you,
what the former CEO thought as well.
true,
Yeah.
true. But hey, you seem quite positive about probably the most positive I've heard you speak about General Electric in a long time. Would you consider even adding to this position now, or you just going to hold?
No, 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 no. It's just a hold. I still own, what is it, $3,000 or something like that in General Electric. I just continue to hold it because I think, from an opportunity cost point of view, the company has done me really well this year because it has been growing, I don't know, with almost 40%. And I don't see it stopping to grow with 20-30% in the next few years
Yeah,
if Larry Culp continues to operate like this until 2023, 2024.
yeah, good.
But it's not the dividend company. It's for me in the 10% non-dividend part of the portfolio, which I have for value plays and turnarounds. And then I classify it as a turnaround.
Good. Good stuff. That's our little mini segment on spin-offs. We might talk a little bit about some earnings, and I know we have a couple of European companies, which is always quite nice. The first company is Siemens, which is a company that we know quite well on the show, and they've done pretty well, I think, this year. They've recovered so well from COVID. Just look at their full year, because it's quarter four and full year for Siemens. Their orders were 71 billion, which is up 23% on last year. Revenue was up 13%. Net income, our earnings per share, is up 54%, which is huge. And free cash flow is about 8 billion. So they've done quite well, I believe. They've also increased the dividend from €3.50 up to €4, which is quite a hike. Um, um, they have added a little bit of depth to their balance sheet, but other than that, it looks okay. But another solid quarter from them. Have you looked at them this quarter?
Yes, yes, I did, and it's actually the full year results, right? So
Yeah,
soon will also come an annual report. I mean, it's just amazing. They had a small dividend cut. That's why they are not anymore in the European Noble 30 Index, dividend aristocrats. But that was because of the spin-off. They did a spin-off of,
yeah.
what was it, GE
Uh,
Energy or something like that, or
the
Health.
Healthineers, Siemens
Yeah,
Healthineers,
Healthineers,
isn't it?
yeah. Sorry, Siemens, yeah. So they did a spin-off at the time, and with that, they also cut the dividend, I believe, from 3.30 to 3
Yeah,
to show the proportional, how is it, outflow of assets.
yeah,
But now they are with the business. They went from 3 then to 350 and 4 during the pandemic as well, right? With all the supply chain issues,
yeah,
it's just amazing because we are talking here about a 14% dividend growth for such a stable company. And I think Siemens is really a play on the future of renewable energy. And I think what's all happening in Glasgow at the moment, I mean, this is all like tailwind for Siemens because it has all the equipment and it's totally, how you say it, how you say it, it's totally positioned to benefit from a lot of these
yeah.
climate change or climate actions by countries.
Yeah, and you can really start to see that in their figures. I mean, health and ears is up 26%, mobility, which is up 38%, and digital industries is up 16%. I suppose I expected smart infrastructure to maybe increase a little bit more, but we might see that over the next year or two. But I mean, some really strong figures from them over the last year, considering all the troubles they had during COVID.
Yeah. So I just wish that the share price came a little bit down again. So the company is a little bit cyclical of nature. So if there comes a financial crisis or economic crisis again, you can expect a company like Siemens to quickly drop to €100 again. But if it gets there at a 4% year yield, I will be buying again.
Yeah.
And that's the same what I did during the pandemic. I bought some Siemens as well again.
Yeah, I think during the pandemic they dropped as low as 70, €60, I think. And now
Exactly.
and now they're 150. Still a quite decent 2.3% yield. But I agree with you. I think they have to come down a small bit before I would buy them.
Yeah. And this 2.3% yield will be, what is it? 2.7 going forward. So not too bad.
Yeah,
Cool. So let's go from Germany a little bit west to Ahold Delhaize then. Um, Everyone, I think, that follows me knows that I was really buying a lot of this in the first quarter of this year
yeah,
at around 21, €22. I really made it a big position. I think it's the number 3 or number 4 position in my portfolio right now.
yeah,
And they smashed it again with their earnings. I mean, up again, free cash flow of approximately 1.7 billion is what their I said expectation is for the full year. You need to know they have a buyback program of 1 billion per year. They have a market cap of 30 billion approximately, so they're still buying back shares at the rate of 3% per year. So this is what you're getting already, plus a dividend of around, what is it? I don't know what it stands now, maybe 2.8 or 3%. So
yeah,
this is already like a 6% shareholder return that you're getting on a single year, plus the growth of the underlying business. What is important to know here from a free cash flow point of view? Um, I said the company with the when you count the dividends plus the share buyback, the company is just in the minus when it comes to the free cash flow consumption. So and that's because they are just leveraging the balance sheet really a little bit up to give better shareholder return when it comes to buybacks. So you need to realize this, but I have no issue with it because the balance sheet is strong enough. They can handle it quite easily. And we know that money is quite cheap at the moment. So it's better to retire some shares for that as long as you stay within your solvency ranges. But also their online business, and this mainly with bol.com as well, but also their delivery business. It's again up with almost 30%, while it already grew with 62% last year. So it doubled in 2 years effectively, which is
Yeah.
amazing. Yeah, and we know that Amazon also brought in competition in the Netherlands, but bol.com is still doing well. It does have an impact on the margins because bol.com at the moment, like Amazon, those are really low margin businesses while they are building out their footprint. But it's just a cash flow machine, this company, and yeah, I'm really amazed again about their third quarter earnings and their good guidance for the full year.
Yeah, and as you said, buying them at 21 euro seemed to be a pretty good move now looking back. I think they're almost at 30 euro now, I
Yeah,
think.
I think they could surpass 30 euros anytime. Yeah, I think it's a bit on the expensive side at the moment. I wouldn't pay more than 26, 27 euro for it myself, but maybe the earnings grow into it. It's not a fast growing business by design. Yeah, in the end, it's a retail chain,
Yeah,
but it's doing really, really well, I would say. And management, especially, is really conservative. They have this UPOT methodology: under promise, over deliver. So at the beginning of the year, it always looks worst. That's what we saw this year. They announced like all kinds of stuff that would be, headwinds this year. Price dropped off in the beginning of the year with 10, 15%. I was a big buyer there. I was really loading up the truck. And we see again, under promise, over deliver. They do this trick every time. They don't care so much about the short term share price. So I hope they do the same again in February, March next year.
yeah, keep doing the same. Keep doing the same. Okay, very good. No, seems very positive. I'm quite happy with the results. As I said, the free cash flow can be a little bit concerning. I would not like to see him do that the whole time. I mean,
Mhm.
I know shareholder returns are important, but I really don't want them to mess up the balance sheet just for that. So
They can stop just the buyback for 1 year,
yeah,
and for the 1 billion can go to the balance sheet, and they clean up probably like 10 years of paying like 100 million too much.
yeah,
So
good. So then I think that the last company then is Allianz. I
yeah,
think
I've also looked a little bit Allianz. So let's go a bit south now over the European map. And so Allianz also, the insurance business is just doing well. 2.3% up again on net income, which is a lot on such a stable company. What can I say about it? It just continues to grow. And by the way, the revenue is up 9.5%. So this is something that I always find interesting. When revenue is growing faster than net income, I would always expect the way around based on fixed cost and variable costs. So there must be some one-time items in there. I haven't checked it fully there. Um, I think their debt position is still good, but what is of course a little bit what people need to continue looking at is this issue that they had earlier this year with the lawsuits around one of the funds that they had. I forgot what the name was. I wrote an article about it on my blog. So if you go to europeandgi.com and search for Allianz, you will find the article about this case. What happened effectively is during the pandemic, they lost a lot of money on one or two of their funds. Like it dropped like through half, and it didn't return. They closed it also. So fund managers and universities and such in our pension funds in the US started to just create lawsuits. At the time, they had one lawsuit for claiming 800 million. But at the moment already, they have a combined 6 billion in damages being claimed towards the company. In my article on my blog, I was anticipating maybe on 3 billion. So it's even worse that 6 billion might even be 8 or 10 billion, which is a lot, right? The company I know is very conservative around this. They already priced a lot in, but because of the share decline earlier this year, they also decided to do a big share buyback. So I think they're quite bullish themselves on these lawsuits. but we know how European companies are dealing with lawsuits in America. And let's talk about Volkswagen, Bayer as well. So you need to discount for this, I would say. And I find the price above 200 too expensive for Allianz. Knowing this, I would rather go to the low 190s again before I'm interested. Good numbers, but these lawsuits, really keep an eye on it. It can bite. It can really bite us.
Yeah. I don't think the number surprises you a whole lot. I remember maybe at the start of the year you were quite bullish on
Yeah,
insurance companies.
yeah.
So
Not, now many have been priced in, although Allianz hasn't moved a lot with their price since the announcement of this case half a year ago. So if you really want to nibble in some or start something, then Allianz could still be worth looking into. But I prefer the claims to be settled first.
so the next section, and we might look at portfolio review. And this came in, I think this came in over Facebook, was it?
Yeah, that's true. So if
Um,
people don't follow us yet, we have a Facebook group. Just type in Dividend Talk on Facebook. You will find us. You find the Facebook page. We have around 500 people following us there. But there's also a group underneath where we have around 160 people there. So just join us, and the group is now in private, right? So everyone can ask questions without your mother and your wife or your husband or your kids seeing what you're typing on the dark web in Facebook. So just join us. It's fun there. And Jeanette van Zyl, one of Jared van Zyl, one of our followers, submitted their portfolio, and he's interested to hear what we think about it.
yeah, and just to give you some of the names then that we're talking about. So we're looking at Danone or Danone, whichever one you prefer. So we're looking at Danone, Vitaris, which is a company I mentioned recently, Medtronic, AT&T, Alibaba, Apple, Iron Mountain, Caterpillar, and there is another one with a ticker ISRG, which I have no clue about.
Yeah, me neither. So I think it's how is it? It's a mixed bag. It's still a starting portfolio, as you can see. Alibaba is the biggest position actually, which I find actually quite defensive, because I think with Alibaba, this is what is right. People will say risky, but for me, when you look at the valuation, it's quite defensive because it's undervalued heavily. So I find that a really good move. I think it has a lot of upside. Other than that, it's I'm missing some typical dividend stocks here. Maybe like what we discussed earlier, something like Johnson and Johnson. It's not having a too low yield, so I'm missing something like 3M. I'm just missing some iconic dividend aristocrats in here. It looks a lot, actually, a little bit like stocks that have been, how is it, recommended on YouTube and such. Like Viatris, I know is really popular via Ian Lopuk. I spoke a lot about Danone earlier this year. I know that Iron Mountain was a lot on social media like few months ago. AT&T on the 30, on the 29, on the 28, or maybe on the 25. So I would say like go to dripinvesting.org as an example, or go to my own blog, European DGI, and I think you have also on your blog, EMF, you have also some nice articles about dividend aristocrats and dividend kings.
Yeah.
Look at them and go a little bit to the basics of what you would have in a dividend growth portfolio.
What we got to remember here is that the portfolio are Yaris is only 2 months into investing, so
Yeah,
he is quite new, and you can see that in the portfolio itself.
yeah,
I mean, I don't think it's too bad for someone that's 2 months in.
definitely not,
As I
definitely
said,
not.
it is a bit of a mixed bag, and it do you know what? It feels very much when I was starting out, and is in
Yes,
you don't know yourself as an investor, and you're probably relying too much on social media outlets and buying, and I think maybe Alibaba is probably one. Um,
exactly.
so I would just look, take it slow, and I can see that you're doing that, but get to know companies. You've mentioned you would like to buy some Johnson Johnson, Unilever, Texas Instruments, even British American tobacco. So maybe just as you said, read as much as you can. Don't rush into anything. Find out what kind of investor you want to be. Is it going to be kind of taking more risks, like with Vitaris, Alibaba, maybe Dell to a certain extent, or do you want to go with dividend kind of a portfolio, but more mature companies, and then maybe start looking at some of the companies like Texas Instruments or Johnson Johnson.
Yeah, I think that's really good advice.
Yeah.
I think we all started like that in the
Oh,
beginning
hey,
here. But
listen,
yeah,
the rubbish I had Waco. I mean, I don't know anything about that company. I just remember buying them, and you just,
yeah,
I mean, it's so easy to get, and I mean, I wouldn't dare mention values, but the valuation is quite small in
yeah,
this portfolio, and it's still so scattered. So I would maybe
yeah.
focus a little bit more on core holdings and build it up gradually.
Mm, yeah. Well, 32 years old, right? From South Africa. So it's really nice to see someone starting and
Yeah.
yeah, really good. So keep it up. Feel free to always ask questions here. And yeah, well, let's put a link to driptools.org in the description of this I said of this podcast on Spotify so that Jared can look it up.
And one thing I would mention: do not use this podcast as best practice, because we get so much stuff wrong. Just use it as a
Yes,
guide, but it's certainly not best practice.
exactly, exactly. This is pub talk. No,
Yes.
no. But sometimes there is investment advice in there. We won't lie.
Investment advice. I'm doing the bunny ears with my fingers.
Yeah, exactly, exactly. Okay, so thanks, Jared, for submitting it and having the courage. Keep on going, and I'm sure you'll get lots of wealth. The start is the hardest, and you've done that already. So good work.
Good stuff.
Okay, so let's go then to the next section, and that's the listeners' questions for today. I think it's about time because I saw we have quite a list. And the first one is from Colin Boylan, one of our followers on Facebook. And he's asking, and based on a scenario, if one of your favorite stocks has a significant correction and poses a buying opportunity, but for instance, the company fundamentals are still sound, would you buy more, which would leave you overweight in that stock? Or, do you think this will negatively impact your diversification and therefore you will pass up on the opportunity on this?
I would buy more. Diversification is a long-term goal of mine. As I mean, I have a set diversification, but I think you can see in my portfolio, I'm 40 or 50% in consumer staples at the moment. So diversification's kind of gone out the window. But I would like to think I would buy more in this scenario.
Same here, and I've done that several times. I've done it with Omega Healthcare at the time. Later on, I also sold a little bit of it again when it went 30-40% up because I felt like well, I'm too much relying on their dividends and I didn't want it to be a tier one company in my portfolio. But I've done it on Ahold as well. I really bought a lot this year from my perspective. Also with AppV, I went all in for what I wanted to have at the time. So yes, that's what I call buying with conviction. When those opportunities arise, you take them. I did the same with Royal Dutch Shell. It's still really my second largest position in my portfolio, more than I like. But it is now at a level where I want it to be like 4 or 5 years from now. So I will probably not add anymore. But the fact that I could buy it at 14 euro and at 16 euro, those were opportunities I just didn't want to miss out on. So yes, I do that. And then afterwards, I can repair the diversification of the portfolio by buying other stocks.
Nice. Okay. Matt has asked us about Microsoft. We talk about it a lot. He wants to know what our current strategy is. Is it fair valued or overpriced? He's kind of thinking, will he be wishing he bought it at this price in 5 years from now? He knows it's a great company, but he's struggling to add to his position. What's your take?
Oh, this is really difficult because $340 for me is too expensive. So if you ask about my fair value, I did a video also earlier this year about it on YouTube, so you can check it out. I think I had it estimated out at around $250 per share, and taking already like 25% growth for the 20% growth or something like that for the first few years. I don't remember correctly. If you really want to have Microsoft and you don't want to miss out on it, what you can do is what some investors do. They buy one share a week or one share a month. So if you know that you want to own, I don't know, 10 or 20 shares of these, and 10 is already quite expensive. But you could just buy one share a month. You dollar cost average into it. You need to, of course, have a low cost broker. But in that case, you wouldn't miss out and you get an average price. Generally speaking, I think it's overvalued right now. I'm holding, I'm not adding anything at the moment. How about you?
Cool. What Matt is describing there is FOMO, isn't it? Fear of missing out,
Yeah, 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 exactly.
and I totally get that, but I suppose it depends on how you feel as an investor. What would you do if you bought that now and it dropped, I don't know, 20, 30% or 40% if we had a market
Good one.
correction? And that's the way you got to look at it. I personally think they're overvalued. I've said this quite a bit on the show, but I feel, honest to God, I feel like we are near the top of a bull market, and there's a correction going to come at some point, and Microsoft will be up there, but over 300, I'm not buying. I'm holding at the moment.
Yeah, good. I hope it helped, Mats. As you know, always our unsalted opinion here. Next question comes from Marcus Isaacson, and he's asking if we see dividend Disney as a dividend play long term. What are the pros and what are the cons, and should it come stronger out of the pandemic? What do we think?
I don't see him as a dividend play anymore since they got rid of it. It may come back. I don't know. But Disney as a company is quite strong. They're doing really well. I expect them to come out stronger after the pandemic, yes. But as a dividend play long term, not on my horizon.
Neither for me. And they also communicated that, right? All the cash flows going to the online streaming business. So
Yeah,
I'm,
they're a growth
yeah,
company now, essentially a
yeah,
growth
they're a
company.
growth company. So I'm staying away from it at the moment because I also don't see it as an undervalued company from a growth perspective.
Cool. The next question then is from Carlos, and he has asked us if we were starting a fresh portfolio, what three stocks or ETFs would you invest in first?
Yeah, that's a really, really difficult question to ask because it means about what is how for what the stocks are trading today. Yeah,
Mm.
probably I would go fall back on my good old Unilever. The company is struggling a little bit, but gives a decent yield. It's a defensive sector, consumer staples, so you can count on it. Another stock that I will probably do is something like not for a core holding, but just to start, right? Because I don't see it as a core holding, but probably some Bristol Myers at the moment. I find them attractively valued. And probably an ETF. But in that case, I'm assuming Carlos is from the States, not from Europe. If Carlos is from the States, I would consider SCHD. Um, Otherwise, I wouldn't really recommend an ETF. First stock for you, Derek.
Oh, I mean, it's harder if we're basing it on valuations. I don't know in my portfolio, but who I choose first is probably Realty Income. I mean, they're a monthly dividend
Oh
paying
yeah,
company, so
good one.
you got to have them in there. After that, I might pick some Aflac, ticker AFL. We have to start saying tickers. Remember, we keep forgetting.
Yeah, 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 sure.
Um, so they would probably be there. I think they're fairly valued. And after that, I'd probably Royal Dutch Shell. But that's because they're my darling. So um, I would probably pick those three starting up.
Nice, nice. Yeah, good old black oil.
Can't beat it.
As long as it stays around 70 and higher, we'll get so filthy rich, and all those green guys and ESG investors will be needing to do with subpar inflation numbers. Good. Then the next one is from Jose Carlos, and he's asking if we could, and probably it's a question to me, if I could summarize the thesis behind my recent acquisition of Rio Tinto, ticker RIO. Because what he's mentioning is it's really correlating to the iron ore price. So, um, yes, there's a strong, let's say, relation with the iron ore price. But I look at it like that. I studied their dividend safety. I studied their balance sheet. I find it good to buy it at these prices. So I bought the first one at £53, now at £44 or something like that. Yes, it can go to 30. I will buy more. You need to know that I buy not a full position at once. So I build up a position over many months. And if I look at it, I find it attractive right now. So I'm not taking the bonus dividends that Rio Tinto has been paying over the last 3-4 years into consideration when I look at the dividend yield. So excluding those bonus dividends, let's assume they won't be there going forward. I think the dividend is pretty safe. And also, when I think about iron ore and these metals or these commodities, if I look at what's going on in the world, I see prices actually only climbing. You know, there's a massive EV boom going on and such. I think there are many headwinds, and what the commodity is doing over on a daily basis, I have no clue. Actually, I'm not a specialist in it as itself around commodity pricing, but I do have a feeling that a company like Rio Tinto and BHP Billiton will continue to do well. And even if a company like Rio Tinto would do a small dividend cut, I'm buying it more for the dividend income, knowing that it could cut it by a little bit in one of the upcoming years. And that's fine. I'm making a conscious decision there.
Cool. Okay. Peter has asked the question again. It's for you, and he is asking how you cope with the very weak PLN, which is the currency in Poland right now. Uh, you are facing kind of high exchange rates, or are you starting to focus on WSE? I don't know what that is. Listed stocks.
Warsaw Stock Exchange.
Ah,
So
I see.
yeah, so this is the issue. I get salary paid in Polish zlotys, and then when I transfer it to the euro, I need to transfer it into euros or dollars, and does it automatically for me when I buy. So I always have this currency risk, and the Polish zloty is getting weaker, which means that I get less euros or dollars for my income. Um, I'm not doing anything with it. I just continue to transfer my 50% savings from my salary every month to my brokerage account, and I continue to just purchase. I don't know where the zloty is going to be. On the other end, I benefit from stronger income in dividends. But you know, this would have been nicer a weaker zloty when my dividends were higher than my expenses. So it's a better situation to live off in retirement now. So the issue is I can't predict the future. Maybe the zloty goes down forward next year, further down. Maybe it goes up. I really don't know. It's the same with when you are in a eurozone country and you're thinking about buying American stocks. You deal with the same, right? And we have seen it because the dollar at a certain moment was $1.60, I believe, in 2009 or 2010.
Yeah.
Then it went all the way to almost $1. And what is it now? $1.20 again?
Yeah, and around that. Yeah.
Yeah, but that's again like 10% in a single year or something like that we've seen, right? At the time. So this can impact your portfolio a lot, and I tend to ignore it. I don't see Poland as the next Argentina or Turkey, where we will see a massive currency crash. So, and no, Piotr, to answer your second question, I will not buy stocks on the Warsaw Stock Exchange. I still need to find one dividend growth stock that I think I would like to own for the next 10 years. I'm sorry.
Okay. The next question is from Christian. He's asked us about Johnson splitting up, which I think we've answered, and also General Electric. But one of his questions, which I loved, was what do we think the names of both companies will be called? Will it be Johnson or Johnson Sons, as in the son of Johnson's? I think they're going to split and call one company Johnson and then the other company Johnson and just take away the end.
But what would then be the ticker? I think the first ticker will be G&G, and the other ticker will be G&G, but then reversed.
Look, God knows what they'll call that the spin off. I don't know, but it'd be quite funny. I would love them to call one Johnson and the other Johnson, ticker JN or and then
Yeah.
NJ
Or Jackson and Jackson,
Jackson.
something like that. Yeah.
Good. The next question is from a name I cannot pronounce, Sol Pass, maybe.
Hmm.
Okay. Thoughts on Unilever, Procter and Gamble, inflation impact on their margins, and what's your pick on a valuation here?
Oh, inflation everywhere, right? And I was reading the other day an article about how to deal with inflation, and for me, it's the same as currency. I mean, do I have any influence on it? No. Can I beat it? No. Companies will show over time whether they can, I said, push the inflation forwards to their consumer. I believe Procter and Gamble and Unilever have such opportunity to do that. So let's see if their margins will indeed shrink. I'm not sure about that. On the short term, it might be because it usually comes in with a delay, right? Such margin corrections. Valuation for me, Unilever under 45 is something for an entry position because that's for me around the fair value price. Unilever around 40 or lower is for me really a buy. That's how I look at it. P&G I don't own because I have Unilever already and other consumer staples. So I find P&G also generally way too overpriced compared to a company like Unilever. So I don't know. I haven't looked into it anytime lately.
Yeah. Cool. The next question then we have is from Chris. Hashtag get vaccinated. What do you do when a company spins off an asset or splits like Johnson and Johnson?
I usually don't do anything. I just collect the shares. It's too early to do anything now. Yeah, so I don't know if there's a hidden premium in this or something like that. So it's really hard for me to say whether I would do anything. Usually, I just let the shares come in, and then I said I decide then what to do with the spin-off business. Sometimes I evaluate it like for 1-2 years, like I did with some other companies. So yeah.
Okay. Question from Bogdan. Do you own or consider owning any fertilizer companies? What is your opinion on the impact of current fertilizer price hike? I mean, I didn't know there was a fertilizer price hike. I assumed it would be a hike in everything, with inflation as we were talking. I don't own any fertilizer companies, but I do own Glanbia and I do own Danone, which could be indirectly impacted by this. I know there's other companies out there like
Mhm.
maybe Archer, Midland Daniels, and Ingredion, which would probably impact this a lot more. Um, but I mean, I treat this as inflation. I assume these companies will pass on the price. I know, for example, in Ingredion, ticker INGR, they have noted this in their annual report. They've said that the price of crops have gone up. It's gone up presumably because of fertilizer as well going up as well. So it is going to happen, and it's just a matter of if they can pass this price on to consumers or not.
Yeah. So I own Bayer with
Oh
Roundup.
yes, of course, yes.
So
A
yeah,
great fertilizer.
let's keep that one for another show.
Okay, Tony, 1 million journey. Tell us about your worst investment mistakes and what you've learned from it.
That was buying a flat in the Netherlands in December 2007, thinking that the only way is up. And that's why you need to own property and not rent property. And I knew that I would only be living there for 3-4 years. Yeah, it has costed me a lot of money.
Yeah, mine is not sticking to your plan. So I remember I spoke about Bitcoin on this show, haven't I, before?
Mm.
And my goal was to always have one full Bitcoin, and I got to that price. I got one full Bitcoin in around 3,000, and I was going to hold it, and then something shiny came along, and I sold it and bought something shiny, and something shiny ended up being shit and not moving anywhere, whereas Bitcoin has gone, as they say, to the moon. So my worst investment mistake is making a plan and doing the complete opposite of what I wrote down on my plan.
Yes, that's why you took the effort of writing it down. But it's I did it as well in the beginning, but that's why I learned to always stick to my plan now.
Yes,
Um,
yes.
but it's hard. It's hard to be honest.
It is hard, but I suppose when something like this happens, it's a good reminder to say, okay, you have a plan for a reason. Stick it
Yeah,
out.
true, true, true. Hey, the next question is from Jan Rakker, and he's asking whether we are considering to buy any interesting stocks in Central Europe. Anything from your side?
Where do we consider Central Europe?
Like what Central Europe really is. So Poland is Central Europe.
Poland, for example, then no is the
No,
answer.
no, for me neither. Jan, let me know if you know any good company. I don't know any. I've really looked a lot into it because Piotr was challenging me often. I've studied many countries in this area and the Baltic states as well. I just didn't find any company that I would like to own. They all have, dubious dividend growth. So, but I would love to have one. I would love to own a Polish company, as an example, just to have a little bit of this I said proximity bias. But no, nothing. Okay, then
Okay,
the
and
I'll
yeah,
take
the
this
last
one for you from
go for it.
Maarten. Maarten is actually quite an active follower. He's engaged a lot with us on the social media. So hi Maarten, nice to get a question from you. And he's asking, what stock had the largest change in your fair value estimate after this earnings season?
For me, I don't know. I have not gone through my fair value estimates in companies during the year, and I typically try and do that maybe at the end of the year, but I haven't looked at the moment.
Yeah, but maybe something that you became more bullish on.
More bullish on no, nothing at the moment. Not in my portfolio. I'm more bullish on
Yeah.
nothing. But
Okay.
to be honest, I was away from the show last week, and
Yeah.
I haven't really been able to focus a whole lot on this earnings season. So it's been a bit of a, a whitewash for me. So I haven't.
Yeah.
I've been a
Yeah, I understand.
yeah.
So Maarten, for me as well, I haven't been changing my fair value. So it is not like when I see Q3 reports coming in that I go back to all my templates and start adjusting the numbers. It's usually not how I work. Like EMF, I look into the companies typically once a year, and that's when I reassess the numbers that I used the last time and update them. Quarter 3 is not really the season for me to do this. Usually, I do this after the annual reports in March or April, the earliest. But having said that, a company that I got more bullish on, I mean, it sounds boring, but Microsoft, I mean, if you look at the whole earnings seasons, they blew it. Yeah. But what I mean positively, look at all the other companies like Amazon, down, IBM, of course, down. But how many companies surprised really and saw that also being returned into share price increases? There are not so many companies. There were so many hits and so many misses this year. So actually, my portfolio generally has done really well. Also, when we look at upfee numbers and such, and I really think there's now a lot of momentum for value companies or value plays and dividend stocks. Because if I saw like Peloton as well, the growth stocks, they have been hammered and slaughtered, some of them. It's been a tough quarter, I think, for many growth investors.
Yeah, yeah, it has been, particularly with Peloton. As I remember somebody saying anybody could slap a fancy iPad and put it on a bike. That was quite that tickled me a little bit. So that was quite funny.
Yeah, but they seem to be really good iPads.
Hey, so that's it. That's the end of the show. We've had, as I said, a packed show. We tried to answer all the questions, so I hope you've stuck with us this long. We know our shows can be quite long sometimes, but we do appreciate all our listeners for sticking around, for liking us on Facebook, talking to us on Facebook and Twitter. As I said, it's much appreciated, and we hope it continues and continues to grow.
Yep. So thank you, everyone. Enjoy this latest episode and speak to you next week again.
See you on the outside.